Hello, everyone, and welcome to today's Blockworks webinar, bringing public market liquidity to private market securities. Today's episode is made possible by DealBox. I'd like to invite our speakers to unmute their lines and turn on video. During the webinar, please submit your questions to our speakers through the Q&A button at the bottom of your screen. We'll save some time at the end of the discussion to answer these. The session will be available on demand. All registrants will receive an email once the recording is live. I'd now like to turn the event over to Blockworks founder, Mike Ippolito. Mike, please go ahead.
Awesome. Thank you so much, Jane. Really excited to dive into this topic here today. We're going to be talking about kind of security tokens and how people are already building out infrastructure to turn what have traditionally been private securities into something that looks more like public securities. Before we do our quick round of intros here, I want to give a shout out to our sponsor, DealBox. They're a very cool platform. It's a vertically integrated platform that's helping to democratize venture capital. So they've got an integrated ecosystem of partners that handles basically any and every need that an issuer may have, on the side of tokenizing securities, and they help match them up with an active network of professional investors. So they really cover everything from compliance and due diligence to investor onboarding to data management and document control. And they've recently been helping entrepreneurs and holders of private equity digitize their cap tables. So really interesting company. You can read about them in media publications like Bloomberg or CNBC, or go check them out at dealbox.com. So without any further ado, I'd love to just dive into our subject matter for today. If we could just do a quick round of intros, gentlemen. Nick, I will pick on you because you are first on my screen here.
Sure thing. Thanks, Michael. This is Nick Grossman. I am Nick Grossman from Union Square Ventures. We're a VC firm out of New York City that's been investing in the traditional internet for the last 15 years, things like Twitter and Etsy and lots of other Web 2.0 application infrastructure platforms, and also in the new internet and the new finance stack around crypto with things like Coinbase and Filecoin and lots of others. And so we're interested in both the evolution of the traditional finance and asset stack, and also the next generation of the internet stack. And those two things are converging here in really exciting ways.
Awesome. Steve, I'll pick on you next.
Sure, I'm Steve McKeon. I'm a partner at Collab+Currency. So our fund is a spin-out from Collaborative Fund, which was founded about a decade ago. Really went to market with a sharing economy thesis. So early investments were things like Lyft and TaskRabbit and Core and Reddit, and sort of all of this peer-to-peer disintermediation through tech. Of course, crypto and blockchain sort of supercharged that thesis. So we eventually spun out a separate vehicle, Collab+Currency. And so our focus is entirely around crypto and blockchains. I've been thinking about security tokens for a long time. I also have a background as a finance professor and have studied securities for some time. So looking forward to the conversation.
Awesome. And guys, we were actually talking about first jobs before we got on this. Steve, I think, has the best first job of anyone I've ever heard. So if he's feeling forthcoming at the end of this webinar, we can get into that little tidbit for y'all to stick around. And last, Mr. John Nance.
Thanks for that, Mike. Good to be here with everybody. I'm John Nance. I'm the newly appointed CEO of DealBox here. And Mike gave a little bit of background on the company with y'all, but mainly three primary verticals here at our business. First and foremost, the investment packaging and due diligence side of the company. Our analyst team has been running that business in different company names over the last 16 years. So during that time frame, we've packaged up over 400 private placements. So that's the core competency here at DealBox. And as Mike mentioned, we work with issuers to really make sure, you'll hear me talk a little bit about this more, but what we call bringing public company best practices to private companies. So the clients that work with DealBox, we really focus on making sure that they understand what the implications of raising capital really are throughout the entire life cycle management and the growth of their company as they aim to experience some type of liquidity event, be it M&A or IPO or some of the things that we'll be talking about today. And then beyond the investment packaging side, we've taken that work in our clients and created one of the very first vertically integrated digital securities enabled online investment platforms. So you can go check that out at dlbx.io today. Those offerings are live, and you can invest in some of the clients that are available on that platform in a digital securities format.
Awesome. All right, thanks everyone. Let's dive right in here. I'm really excited to kind of dig into the meat here. So today we're going to be talking about kind of security tokens and how some of the folks on this panel are helping to create a much more liquid market for private securities. I think it'd be great to just making sure we're covering our bases here. Let's start at a really kind of basic level. So let's just do a quick refresh on what is a security token and how does that differ from its sort of cousin, a utility token, whoever's feeling brave.
I think that's one for Steve.
Sure. Yeah, I'll dive right in there. First of all, I would say that there's not necessarily consensus on a single definition, but let me give you my definition, and then the other panelists can jump in if they want to refine it. So I defined, when I was first writing about this, I defined a security token as any cryptographic representation of value. So sort of anything that's on a blockchain that is subject to securities laws. Now that captures, of course, there's a huge gray area in terms of what should be subject to securities laws or not. But I think for the purpose of our conversation today, a lot of people will restrict it to the idea of traditional assets, right? So if you bring a representation of equity, corporate equity, or you bring a fixed income instrument, or you bring real estate, and you represent that ownership claim with a token, that would be sort of like the classic definition of a security token. And then the sort of other category would be network assets. So these are sort of the new generation of assets, not traditional assets, that are subject to security laws because of some feature of payout or other aspect.
For the audience, could you just define, how are you defining a new generation of asset here? Are you talking about cryptographic assets?
Right. So if you had if you had a distributed network of some type, right? So I'll just pick one. So Filecoin, for example, right? So if the US government decided that Filecoin was a security, technically that would now be a security token. And so all I was trying to say, so Filecoin is, again, it doesn't represent traditional equity or fixed income. It's sort of it's a network asset. And I think for the purposes of today, I think probably it's easier to focus on more of the idea of traditional assets that are represented on chain.
And Steve, I'll take that a step further because I think, there are your definition of tokens that are regulated as securities. And then I think there's also a new wave of securities that are getting tokenized. And those tokenized securities may or may not live in the regulated world. So I think there's both this sort of a class of tokens that are security tokens that trade on an ATS and don't mix with other kinds of non-securities tokens, which is, I think, where the original conversation over the last few years of security tokens kind of has been. And then at the same time, we're also seeing wrapped versions of securities that are becoming tokenized and trading, internationally in lots of places, interconnecting with sort of DeFi infrastructure, international, trading houses and exchanges that are traditional securities that are living in the non-security tokenized world. And so I think both of those things are happening right now at the same time, which has, for me at least, broadened my conception of what I think we might be talking about when we're talking about security tokens.
Yeah, that's great. And I'll chime in just really briefly. Steve and Nick, thanks for that. As the nomenclature and the landscape evolves, what's been happening is providers of these types of services are more able to identify what is a utility token, what is a security token, what's regulated by what jurisdictions. And so as that nomenclature evolves, we've kind of taken to calling them more along the lines of either digital securities or more aptly, in our opinion, programmable assets. And this idea kind of alleviates some of the issues around what a fund mandate that maybe potentially either of your funds might have around investing in quote tokens or what those theses are as it pertains to the technology or the issuance of those securities themselves. So the programmable asset language is something we've been weaving into PPMs and subscription agreements for just about a year now as we phased out kind of that token nomenclature from 2018.
So maybe honing in on one of those types of security tokens there, which is taking very traditional assets, be it equities or a bond or kind of ownership of a hard asset like real estate, and basically putting a new investment wrapper on that. And it seems like actually the new investment wrapper format has actually given birth to a whole other type of securities, which Nick, you were kind of alluding to there. And we're going to talk later about how that kind of integrates into these new systems in DeFi. But let's focus on kind of I almost want to call it the vanilla version of what we're talking about, which is taking existing assets, putting it in a new investment wrapper. What are some of the advantages of this new security token investment wrapper? Like, why is it maybe better or worse, or what are some of the trade-offs of architecting an asset in this tokenized form versus how it traditionally functions in financial markets?
That's a great question, Mike. I'll take that one to start. So first and foremost, I think that the most valuable thing there is actually the certainty of ownership. Most famously, there's this rumor that Facebook spent upwards of $10 million condensing and verifying their cap table before filing to go public. And so when you're going to take an asset and make it available outside of its own private walled garden in a Google spreadsheet or whoever your cap table provider is, you need that certainty of ownership. There are solutions like that available today in the private markets for cap table management, but being able to digitize it and actually see it on a public blockchain is particularly interesting for that distributed ledger and also verification of proof of ownership. But the second component that's really interesting to us is actually the transferability of that asset, which obviously we'll get into a little bit later when we talk about these exchanges and markets that are developing for those things. But liquidity aside, the ability to move these things relatively quickly and efficiently. So it's those two things on our end for the assets that we have quote tokenized so far to date. But love to hear from Steve and Nick.
Sure, I'll jump in. So yeah, I mean, I think just drilling down, one of the things people often point to is liquidity, right? So there's a variety of different potential benefits. John alluded to several of those. And I think with regards to liquidity, you have to solve for deeper markets. And I guess I would put it into two general categories. So you have to so again, just tokenizing it itself doesn't necessarily lead to more liquidity. It has to be something that does in terms of relieving some sort of market friction, which is going to lead to deeper markets. So I would put those in two categories. One would be access frictions. So maybe globally, like it's perhaps it's difficult for somebody in Korea to get exposure to San Francisco real estate, or somebody in Indonesia to buy Facebook stock. So potentially by wrapping it into a token, putting it into these trading venues that can sort of operate globally, you reduce some market segmentation. And there's been a lot of wealth generated within crypto. So perhaps there's just a pool of traders that would prefer to interact with securities in this way. So one is access frictions. The other large category of frictions I would just say is counterparties, and sort of getting people to show up at the same time in order to facilitate trade. And that could potentially be solved by automated market makers. And so, when I was writing about this several years ago, I was pointing to Bancor. We now have had several new AMMs pop up, Uniswap and Balancer. And the challenge there is just kind of fitting it within securities laws, right? Because I think one option might be something called a Balancer private pool, where it sort of restricts who can add liquidity into it. And I don't know if we want to dive deep into the technical details, but I would say AMMs have a lot of promise for just facilitating people to be able to trade the asset whenever they want, even if there's not another live counterparty on the other side, because now they can trade directly against a protocol.
And Steve or Nick, because it looks like you're about to say something too, would you mind just defining what an AMM or automated market maker is for the audience?
Sure. Yes. So
yeah, go for it, Steve.
Yeah. So just briefly, an automated market maker is where imagine so let's take Microsoft, right? So let's say I took a bunch of Microsoft shares and a bunch of dollars, and I put them into a pool, and I stipulated the price at which somebody could buy or sell Microsoft, right? And then when they made that trade, the price moved a little bit, and there's something called a bonding curve. And so the idea is when people come in and they're just trading against the pool, there doesn't have to be another live sort of counterparty on the other side, because you're always just trading against this pool. And if people come in and they're buying a lot of Microsoft shares, then the price of Microsoft is going up, and vice versa. So Nick might have something to add to that.
No, that's right. And I think that an AMM is a good example of always available, programmable, global infrastructure. And when I think about like, what does tokenization bring to securities, it's the same thing that tokenization brings to any asset, whether that's money or a trading card or anything else, which is, I kind of think of it in layers. Like traditional assets of all those kinds live at the institution and contract layer, which bumps into all these frictions around the world and relies on people and paperwork and lawyers. And tokenized infrastructure lives on top of that at the internet, where they live natively in this global, always available, kind of automatic programmable medium, which enables better finality, less friction, more programmability, more interoperability. And because most of the blockchain infrastructure is not corporate operated, but it is peer-to-peer, sort of like the way the internet is, it all just works all the time, and it's not reliant on accounts. It's you have these kind of bearer assets and this notion of sort of private key pairs that just work all the time, anywhere, no matter what. And I think that enables the really exciting characteristics of this fabric. And then it also introduces like a zillion like legal and regulatory questions, because you start removing all these frictions. There are a lot of laws in place to enforce those frictions, and so that's a whole nother conversation. But that's kind of my high level framework for thinking about the advantages and the benefits of the technology.
Yeah. So I think, when it comes to tokenization, what I'm hearing from all of you is that it's just in a lot of ways a better way to own securities in a way that reduces friction, specifically, frictions in transactions. And I think tokenization is really something that applies, at least in the immediate to midterm, maybe to more private market type securities. And anyone who owns private securities on this call probably knows a lot of those frictions firsthand, just in terms of how illiquid those securities tend to be and how much of a pain in the ass it is to transact, basically. I think that kind of story about, hey, this isn't really that different, tokenization, it really is just a better way to own private market securities, that really caught on in 2017, 2018. And there was a lot of talk about, a lot of platforms were kind of spun up to trade these things. There was a lot of excitement, but it never really quite took off in the way that people thought it was going to. So I guess I'll just pose the question to all of you. Why didn't that market for tokenized securities see any traction after all that excitement in 2017, 2018?
Yeah, I guess I'll start on that one, Mike. That's a great question. So for our side of the fence, I think it's really two considerations. Number one is what we would consider issuer quality. So the amount of information that's available to a purchaser and an investor in that type of asset. So when you're dealing with something new and exciting from a technology standpoint, I'm, as an investor, open to considering that instrument, but now I need to make sure that the company itself is strong. So, normal investment diligence considerations. And so a lot of the earlier companies that were looking to take advantage of these instruments were not necessarily stood up as best as they could from, say, a traditional VC or PE diligence standpoint. Of course, there's some exceptions to that, but by and large, that was generally the case. And then the secondary part, I would say, is really around the technology itself. Things like the ERC-20 or 1404 protocols were not necessarily as large as they've grown today. Obviously, it sounds like we might spend some time talking about DeFi, but for us, we initially, when we issued our DLBX quote tokens, which have an ownership interest in both our venture investing activities and the operations of the company, we initially chose to issue them on Stellar because we were worried about the network speed of the Ethereum network. And as things have progressed, we've actually migrated since off of the Stellar blockchain and onto the Tezos blockchain, looking at things like their self-amending FA2 protocols. And so those are kinds of the things on my side, at least for my answer, which would be number one, issuer quality, and number two, certainty around the technology and being able to make an informed decision around what types of protocols to use and why.
The other thing I would add is so I agree with John that there was definitely some deals that were coming to market that weren't high quality, although there were some deals that were high quality and they still didn't see a ton of volume. So like BCAP, which is effectively a piece of a VC fund, the net asset value is up, I think, 600% since they issued that in 2017. We still haven't seen a ton of trading in it, and I think a lot of it was just sort of infrastructure friction. So when BCAP was launched, there were no qualified custodians to hold this thing. There were no venues that were licensed to trade tokenized securities. There was, just a variety, the compliance systems, things like Securities and Vertalo and TokensOff didn't exist. And so I think one of the things that's really happened over the last, say, 3 years is all of that stuff is starting to come into place now, right? So Anchorage and Coinbase, and there's several others that now can custody securities in tokenized form. We've got a variety of trading venues coming online with INX and Archex in Europe. And a lot of the compliance issues have been solved by some of these companies I just mentioned a minute ago. So I'm quite excited for the next year or two to see how this unfolds, because it felt like there was just a lot of missing pieces, and a lot of those gaps have now been filled really just for the first time. But I think, to me, the biggest friction was this lack of infrastructure.
Yeah, and I think that's right. And I think at the beginning, when the story around security tokens was, tokenize these things and make them tokens, and then it was kind of and now what? In addition to the infrastructure not being there. And I think when the story of securities tokens was only and these trade on an ATS and they're separate from all other tokens, and all that infrastructure wasn't there, I think it was just harder to really see the benefit. And a lot of the infrastructure has come into place. And then now also so much DeFi infrastructure has come into place, things like Uniswap and all these other protocols where, for certain types of tokenized assets, once you can get into that ecosystem, a lot of things happen. I think another thing that it feels like has really driven an understanding of all this is tokenized dollars. So, which are not, securities like we're talking about, but, USDT, Tether, and USDC have become really important within the crypto ecosystem as tokenized versions of, offline assets. And I think has started to show, okay, you can take dollars and tokenize them, and once they're tokenized, they become much more useful for all the ways that we talked about. And I think, and then that also, I think, has paved the way for a lot of this supporting infrastructure on, like DealBox and TokenSoft and Securities, like the value of issuance platforms and, securing those assets against the tokenized version. Like there's a fuller picture now that there just really wasn't a couple of years ago. I think it's super exciting.
Yeah, so I want to connect the idea back of what you guys were speaking about before with AMMs, or automated market makers, and kind of this lack of infrastructure, because I think that's a really critical point. The analogy that I would almost kind of use is how the iPhone as a piece of hardware really helped along with a lot of internet businesses. Like there's a pretty funny game called Dot Bomb that everyone should check out, which was made a little while ago. It was every quote unquote bad idea from the 2001 tech bubble burst. Or the dot-com bubble. And it was things like grocery and delivery and all of this kind of stuff that are now the unicorns today, right? And the kind of missing bit of infrastructure back then was you needed this iPhone, which was a remote control for your world, because something like ride hailing, that doesn't really make sense, right? If you got to do it through your desktop computer, when you have a superpower computer in your hand, suddenly the value proposition of that is a lot more compelling. So I think, I'd really like to kind of move in here to talk about these automated market makers and why liquidity is so key here. Because if you really put yourself in the, from the standpoint of an issuer, right, which John, that's kind of what you were saying, we need people to issue, deals in this new form of tokenized securities. Liquidity is just so key, because it doesn't matter how cool it is and yada, yada. You, at the end of the day, need to know that if you issue a security and it's tokenized, that there's going to be buyers in a liquid market. So Does that analogy kind of ring true with you guys? Is liquidity the ultimate determinant? And are market makers kind of a key infrastructure there? Or what do you guys think about that?
Yeah, I mean, I think liquidity is one of the key benefits that has been elusive, but that people have been pointing to since the beginning. And to me, the exciting thing about automated market makers is that the company itself can post the pool, right? So if you issue tokenized equity, you could take a bunch of those tokenized shares plus some stable coins, as Nick mentioned, and you could actually create the initial pool, which facilitates sort of instant liquidity, not for gigantic blocks, but certainly for retail traders to move in and out anytime they choose, which is just game changing relative to, the way we think about private securities changing hands now, which is just a huge process to go out and find a buyer. And there's typically a bunch of paperwork. And so I do think AMMs are going to be really influential. I think they're actually going to be more influential in securities than potentially the network assets in the long run. But I do think there's a lot of compliance issues to work through.
Yeah, I'll piggyback on that really quickly. I'm not as familiar with the research that Steve is as it relates to AMMs, but liquidity is that missing piece. I mean, you look at the ATS market today, the likes of T0 or INX or Archax and some of the other ones that are available out there, and it's a classic case of chicken and the egg, right? Now that we've got regulatory certainty around these things, compliance is there, quality issues are starting to look at these types of things as options. Now the ATS world is kind of in this situation where, like I mentioned, it's a chicken and the egg, right? So will quality issues and infrastructure, market makers, bid density, market depth beget liquidity, or does liquidity beget the other direction, right? Quality issues and those types of things. So it is a critical moment, but like Steve said, last year in our eyes was kind of the year of regulatory certainty and technology certainty, and now I think we're going to move into, over the next 1 to 3 years, what liquidity certainty looks like, what exchange certainty looks like. And so these are, some of the things we're thinking about today. They can still be a little bit early, but again, with the technology and the regulatory certainty, you can feel confident that at least these things are possible. There's still work to be done, but that's our opinion.
I think what we've seen also in the past couple of years is that the less regulated, marketplaces are leading the way in terms of opening up the market for better and for worse, right? So AMMs being, just software that runs on a blockchain, where anybody can post a trading pair and kind of make a market, instantly. But the other side of that is, offshore exchanges that are trading in tokenized securities, like FTX and others, or even Binance. And so I think that has, I don't know what that's going to mean for the kind of ATS, regulated ATS market in the US, but it feels like that's been the slowest to develop for kind of obvious reasons. And so I'm kind of curious to see what happens there. And I'm not in that business really, but I'm not an expert on all the legal issues, but it does feel like that's kind of the dynamic that's pulling things.
For those of you, for those in the audience that might not be aware, can you describe what FTX is doing with kind of some of their pre-IPO shares, like Coinbase, kind of as a recent example?
Yeah, and they're not probably the only ones doing this, but they're the one I've been following most closely because we're shareholders in Coinbase, and they are shares are trading on FTX. So there are synthetic private market shares trading on the FTX exchange. I think FTX is out of Hong Kong. I don't know how it really all came together, but presumably there are some real shares, in the hands of some real people who've pledged them, into this market. And there's they've minted basically tokenized versions of those shares and they're trading. And I guess I would only assume that will happen more and more and more often with private shares in different places, whether that's on FTX or other, offshore exchanges or through, certainly that's already happening in the regulated financial world in the US, but I think it will continue to happen in this way, one way or another.
Yeah, I think that's a particularly interesting example as well, because I want to definitely kind kind of dive deeper on one particular class of private securities, which is private equity, kind of in early stage companies, right? And I think the reason why this is such an interesting trend to hone in on is because companies are staying private longer, right? And if you are, I mean, certainly the founder, but if you're an early stage employee at a company like Airbnb, right, that's been private for 10 plus years, the vast majority of your net worth is tied up in that company, right? And that's great, right? At the end of the day, when it IPOs, but you really can't access that wealth for a really long period of time, honestly. You know, and people need liquidity. They need to be able to access that wealth to put a down payment on a house or buy a car or put their kids through school or whatever it is. So John, I know this is something that you guys are really focusing on at DealBox. Can you talk to me a little bit about, you know, what you guys are doing to help founders, early stage employees access liquidity for their private shares?
Yeah, that's great, Mike. Thanks. You know, one of the things we think is really interesting is the complexity of cap tables in private versus public companies. When you file a company, you know, to go public and you actually are trading common shares on a major exchange like the NYSE or the NASDAQ, effectively you collapse your cap table into basically what might be two classes of shares that are voting, non-voting, and everything is common and traded on the exchange. But before you do that, as I alluded to earlier, you know, Facebook spending 8 figures to figure out their cap table. These are the types of things you have in complexity. So, you know, you've got waterfalls, preferreds, you know, non-voting, voting, you got warrants, options, all these crazy things. And so for a private company to really be able to manage that information, again, there are people that solve these types of things or are solving these types of things in the private market space, but they're not doing them with the same types of digital capabilities that we are today when we look at what we call with our partners over at Vertalo, digital asset data management. And so kind of taking the analog pipes and wires that are used in other private cap table solutions today and making those things more efficient, more streamlined, more capable for the future of some of this liquidity on ATSs or on things like Nick was talking about. So those are kind of the things that we think about. But I wanted to address a question from the audience as I'm answering this, and I want to make sure I have the right one here. So someone is asking about the balance striking between private and public companies and the amount of disclosures and documentation. So generally, you know, when you go to list on an ATS or an exchange and you're going to work with a market maker or a FINRA regulated broker dealer, you're going to be subject to the Reg SK compliance framework. And that's generally what your diligence team will use to construct a compliance notebook, what used to be hard copy delivered to the market makers. Obviously, everything is digital today. But in thinking through some of those things from this audience question here, you kind of strike a balance between, you know, kind of this mezzanine level offering, right, which is semi-private, semi-public, and when working with an ATS. So those disclosures are still going to be there, but they're not going to be at the same schedule. They're not going to be held to the exact same standards as they would be with the full S1 filing. So those are just the kind of the initial considerations about when you move from an actual private company, how do you start to manage that data first and foremost? And secondly, before you actually look to a full scale S1 or a fully public event, what stepping stones might there be along the way in these MES level opportunities in the ATS world, and what do those disclosure items look like? So that was a great question from the audience. Thank you for asking that.
So I think there are a couple implications here that I really want to explore. And one is kind of on the employee level, and one is on sort of the issuer level as well. How do some of these innovations that you're talking about, especially the kind of the combination of tokenized shares and something like AMMs creating liquidity for those tokenized shares, how does that impact early stage capital formation, basically? Because you could kind of envision a future, right, where if there's a really liquid market for private shares, that's great on an employee standpoint because, hey, suddenly I can, you know, maybe easily sell some of my early stage shares, take a little money off the table and not pay a huge illiquidity discount. But also companies might start thinking, you know, why am I going, I'm talking to two VCs, why am I going to my VCs for this? There's a big liquid market. I'm a famous sort of company. Maybe I could just sell shares to the wider public. I'm curious, Steve and Nick, what you both think about something like that.
Yeah.
Yeah, go ahead, Steve.
No, go for it.
Well, there's a couple different ideas in there, and I think before you even get to tokenized shares and AMMs, there's already a lot of activity in the startup ecosystem around bringing liquidity into the private market more. So you see more secondaries, more tenders, happening more often in private companies. We're investors in a company called Carta, which, digitizes cap tables and then also facilitates these kinds of transactions. And that's becoming, more and more important for companies that stay private longer. And I think it's completely reasonable, if you're an employee, a 10-year employee of a private company, to seek some liquidity there. And I think it's totally fair. From the company's perspective, I think you have to keep that in mind as a desire of your employees. And also, there's always the desire to manage your cap table. And so on the, looking at the employee side, if you assume that there's going to be liquidity coming in different ways, then maybe that causes you to think a little bit differently about vesting schedules, and the way that you do grants. And then, to your question, Mike, about, why not just raise, from the liquid, sort of more liquid private markets or the public markets. In my view, early stage founders are rightfully careful about who they raise money from and when. And, the VCs aren't here just for the money. We're here for the alignment and the patience and the vision. And I don't think that's BS. I think, there's a reason why certain types of investors take early stage long-term risk and why certain types of founders want that. And I think it'll be a balance between, the availability of capital and also the kind of potential fickleness of that capital at different times, in addition to whatever kind of compliance and transparency obligations. And so I think it's all good. And at the end of the day, it's just, I think, more options for founders and employees, and everybody's going to need to figure out how to strike the right balance.
I would add one thing too, which is that, thinking about sort of informational frictions is really important, because even setting crypto and blockchain to the side, we've seen many examples of companies that could have gone liquid, through an IPO way before they actually did, right? So they're just continuing to take venture capital. So you have to ask yourself, why is that, right? In order to answer this question of like, all right, now that we have a tokenized form, are they going to go liquid earlier? Well, the first question is like, why aren't they going liquid earlier, even in the traditional system? And part of it is because for a regular security, there's enormous sort of informational costs, right? When you're a private company, you're not subject to all the SEC reporting stuff. And I want to distinguish this from some of the network assets. So let's take like a Uniswap, right? So Uniswap has a token that can be traded, and it happened relatively early in their life, like compared to say an Airbnb or an Uber. But for Uniswap, because it's natively crypto and everything's on chain, I can learn everything I need to know about Uniswap just right out in public view, right? I can see the governance happening. I can see how much transaction volume they have. Like, they don't need disclosure because it's all right out there for us to look at, right? Whereas when you
can
look
see
at
all the code, right,
that's issuing equity, they're now going to, I mean, that is a big part of securities regulations, is making sure that they're disclosing information that investors need. And that's a big lift. And so I think to the extent that that still exists, even if they're in tokenized form, that's still going to be a friction in terms of going public earlier.
So that's so right. And it reminded me of one other thing, which I think is, we haven't talked about, but which feels important, which is, there are other stakeholders around a company and a project besides the founders and the investors and the employees. I think one of the most exciting directions is bringing in more people as stakeholders. So, and I mean like users, partners, and I think that is like kind of built into the psychology of pure crypto projects like Uniswap or anything else, where the stakeholders have the token and participate in the governance and benefit and all these other things. But in traditional equity land, that's been really hard to do. And if you take the combination of, securitizing or tokenizing securities, and some innovations in legal, particularly around Reg CF and Reg A+, and I think there are some efforts to try and help companies sell or give equity to their users and other stakeholders not just their employees. And I think that's super exciting. Projects like Fairmint and Republic are doing this. And to me, what I like about that is that it, you know, broadens the capital base, but it also, like, it's just a new thing. It's a new behavior that was always really hard before, and now is a lot less hard. And I think we're going to end up seeing a lot more of that in the security token world over time.
John or Steve, anything to add to that?
Yeah, I mean, yeah, go ahead, John.
Please.
I guess the only thing I would add is just, I think just going back to this, you know, discussion about infrastructure frictions that we were having a few minutes ago. I do think one of the last missing pieces that I don't think is totally solved yet is just on this information flow. So one of the amazing things about tokenized securities is you can see exactly who holds it, right? And it should be the case that we can push information and disclosure directly to the wallets, because that's the beauty. Like, the wallet holds the asset, we can push dividends there, we can push information there, we can push all of this stuff directly to the wallet. But those platforms just really haven't been totally built out yet, in my view. And so that's like one of the things I hope to see in the coming years.
And I think we don't yet know what are all the appropriate disclosures for crypto related projects, aside from more, you know, security tokens. And, you know, Masari has done some work on this. Commissioner Peirce at the SEC has done some work on this with her ideas around, you know, safe harbors. And I think, you know, kind of putting security tokens aside, the S1 isn't the right set of disclosures for a token project, and it's kind of what we got. And so I agree, Steve. I think, like, figuring out the appropriate disclosures and the way to make them, like, automatic is undone and super important.
Yeah, absolutely. So I guess, you know, last question that I'll kind of end on here, and then we can open it up to audience questions. And we already have a bunch. John answered one question from the audience, but for those of you listening, this is your time. Enter any questions that you have into that Q&A box at the bottom of the screen. But what is there a catalyst that really needs to happen here to get things moving? It seems like the benefits are very clear, right? And there are a whole bunch of pieces of infrastructure that sort of need to fall into place. But is there one critical bit of infrastructure, or what do you see being a kind of a catalyst, right? In the same way that in a lot of ways MicroStrategy was for Bitcoin and corporates getting involved. Is there one thing that kind of needs to happen that's really going to cause this market to take off, or is it just a lot of little things that all really need to fall into place for it to, the value proposition to make sense?
That's a great question. I think it's paramount. So to the little pieces that need to fall into place, I think, you know, Nick and Steve and myself have covered a lot of those today. There's obviously much more underlying that, but foundationally, that infrastructure is pretty well defined. So for us, you know, we refer to the moments you're asking about as lightning strikes, right? What is this lightning strike seminal event that really either convinces the public or changes the mindset of what is this category that we're here discussing? And on my side, at least in my opinion, how I'll answer is a really strong quality issue of a company that maybe has, you know, some kind of public representation, like a MicroStrategy in Bitcoin example you used. Say, let's tokenize part of our portfolio or some type of holdings company or subsidiary. This is actually something we're working on currently with a publicly traded company. And so when you spin off a piece of those public assets into a holdings company or subsidiary, you digitize those assets and then you list them on something like an ATS or one of these other secondary types of exchanges. And then you can actually have liquidity and trading in that type of quality issue. That's the lightning strike event for us. But to answer your question a little bit further, what is that piece missing? You know, we talked about it briefly, which is really that liquidity and that market depth. So it is the biggest risk. People are working on it, but that's the last missing piece. To us, everything else is infrastructure is set in place.
The thing I would add, I guess, the catalyst we've been looking at for years is just proliferation of digital wallets, just sort of like the interface through which investors are going to engage with all these systems, right? And Yeah, it's like, look, a lot of investors still are scared of using something like MetaMask, or they don't want to deal with private keys. So there are still little things like key management systems and just making everything comfortable, right? So, what is the catalyst that will cause lots of people to onboard into the system? Because like once you get in, you start using these things, you realize they're not that scary, and there's a set of best practices you follow, but overall it's pretty comfortable. But like making that leap it's a big source of friction for a lot of people, right? They'd rather just log on to Fidelity or whatever and trade their assets that way. And so what's going to cause people to make that leap? It's got to be that they can get access to something that they really just can't get access to anywhere else. And so is that going to be a super high profile issuance? Or is it going to be just maybe people outside the US, like in other geographic areas, wanting access to US assets? You can think of a bunch of different ways that could happen, but that is what the catalyst is going to look like, is something that promotes the onboarding into possessing a digital wallet.
Steve, how are you going to drop a bomb on us like that with 13 minutes left in this session? There is so much to unpack there. My God. That was great. Sorry, Nick, I didn't mean to cut you off, but
no,
really
I was gonna say the same thing about on-ramps and wallets. I think for broad adoption, that's the area of the most friction right now. It just is. And especially if you're looking at, new forms and new users for these types of assets, like the users of a company becoming shareholders and by way of tokenized versions of the securities, of the equity, the onboarding has to be far, far, far better. And I also agree that like the access to the market is probably going to be the biggest driver in the meantime, with the international access to US stocks, for instance. Like that's already driving a lot of volume. So I'm just repeating and seconding Steve's point. I think that's exactly right.
That was awesome. Guys, thank you so much for a really fascinating interview portion of our webinar here today. That was really great. Definitely given all of us a lot to think about. We've got a whole ton of audience questions here, so I just want to make sure that we get through as many as we possibly can. And then at the end of the session, I'll give you guys time to indicate to the audience, if we don't have time, what's the best way to reach out. One, kind of just going in chronological order here. One question that I think is really good is what can be done from a kind of regulatory and policy perspective to speed things up, in this new marketplace?
Yeah, I'll take that one, Mike. Audience member, thank you for asking that. So I think Nick alluded to, some of the changes that have been filed around, Reg CF exemptions and, what the maximum capital raise is from that, moving from that 1.07 and change max up to that 5 million. But one of the really interesting components in the fine print of that is that these issuers actually need to identify ahead of that raise a regulated transfer agent to help facilitate that capital raise. That's something that a lot of firms that are using Reg CF exemption today are not thinking about. On average, there's about 600 Reg CFs that go out on a yearly basis, raising around 250,000 on average. So it's quite a bit of capital. Presumably that number will go up both in terms of cap raise and number of companies filing under that exemption now that it's a higher maximum. But those are the types of things that companies like Vertalo, which Steve and myself have brought up today on the call, are solving for, right? There are very few businesses, at least here in the United States, that have SEC registered transfer agent licenses for digital assets. It's an extreme rarity. So if you're looking to utilize this type of technology for a security and you're looking to fundraise on the capital formation side and you want to use business, you're going to need to work with companies like this. There's really no way around it unless you want to work with some of the antiquated other transfer agents, which, no offense, but good luck with that. And then, secondarily, the last thing I'll add is to where I think that the policymakers can help, and they are listening to us now as we talk about these things, is a relaxation of what is the accredited investor definition. We've seen things like professional securities allowing for that. Maybe lowering the income thresholds in line with what is, kind of the middle class, which was what this is Reg D was designed for in the first place. But there's a whole myriad of these things. I'll just end by saying, about 2 years ago when Mike and I were first talking about these things, we were hoping that the SEC would be listening, and it's clear that they're listening. So the good news is that they're at least paying attention to the things that people are saying out here. But the bad news is that it might take a little bit of time to implement. And then also it's just going to require more regulatory technology, the reg tech market. So all in there.
Absolutely. So moving on to our next question here, and Steve, this is actually a pretty interesting aspect that you brought up, just kind of the internationality of this new marketplace, right? The crypto is a global market. Do you think that certain other countries, that this marketplace will actually take off before the US, or is the US kind of the best suited marketplace where you think security tokens would take off? And then there's a follow-up question, but I'll start with that.
Yeah, so circling back to a point that Nick raised right at the very beginning, like around the definition of security tokens, if you include synthetic assets that mimic securities, that is definitely going to take off outside the US before the US.
Already happening.
Yeah, it's already happening. So like Terra launched Mirror Protocol. They've got replications of Netflix stock and Amazon stock and Tesla stock and a bunch of sort of US securities that maybe otherwise are harder to access outside the US. And so I would say definitely outside the US. In terms of, I think there is a market for US based assets selling outside, even non-synthetic versions. So, and I think real estate is one that people point to a lot, right? So if you want a truly diversified real estate portfolio, you'd have exposure sort of all over the world, but that can be challenging even with REITs. Like you can't really tailor the exposure in really narrowly. And so I do think like real estate could be a place where you see more international appetite, both for assets in the US and for US investors for exposure outside the US.
You're on mute, Mike.
Thanks. Nick, you were nodding along there. Anything to add to that?
No, I agree. Yeah.
Awesome. Great. Can you guys talk a little bit about the recent announcement from the OCC and kind of making equivalent sort of SWIFT as a technology and payment networks like stablecoins? Stablecoins have been a really important piece of market structure as well in kind of decentralized DeFi. Can you talk a little bit about the significance of that announcement coming out of the OCC, and will that have an impact on the creation of markets for security tokens?
Yeah, well, I think the announcement is a big deal. Stablecoins are a big deal. And right now, you really primarily seeing stablecoins in the back end of crypto infrastructure, among traders. But I think this opens up the door for much wider use of stablecoins for payments and remittances. And already there's I don't know what the recent numbers are, but there's tens of billions of dollars of assets in Tether and USD coin. When Diem launches, which was formerly known as Libra, you're going to start to see stablecoin based payments, integrated into mainstream social applications with millions and billions of users. I'm sure you're going to see the same thing with PayPal, and basically anybody else that's doing payments is going to look at stablecoin based payments as an opportunity, especially when there's international use cases here. So that, to me, that feels like a really, really, really important driver. And to Steve's earlier point about like getting wallets in people's hands, I think it's likely that stable coins will be a big driver of just getting people wallet enabled. And then once people are wallet enabled, you can start to put other things in those wallets, including but not limited to security tokens.
Awesome. I hate to ask you guys to speculate, but there have been a lot of questions about Gary Gensler and his recent appointment. Do any of you have thoughts on, and actually, just in general, we're seeing a big transition politically, right? There's a whole new group of people that are kind of coming into power. There's a kind of widespread perception that the regulatory attitude towards crypto assets in general, security tokens included, might change or shift. So I guess two-part question, if any of you have specific thoughts on Gary Gensler's appointment and what that may mean for this ecosystem, please share. And just in general, the kind of shift to the Democratic Party, how do you see that impacting regulation of the space going forward?
I guess I'll start with the secondary part of that question, Mike. I mean, it's important to remember that the Jobs Act for general solicitation of private placements was enacted under a Democratic Party. And we haven't really had a chance to reform those regulations under a Democratic Party since.
Mhm.
And so a potential Jobs Act 2.0, if you will, to the comments we were discussing about SEC updates on, general solicitation of raising capital through public channels. I think that there's a unique opportunity with the Democratic administration, House, Senate, executive branch controlled, that we could see some of the demand that's coming out of the average person, the impact and the comments being given to the administration and the SEC. I could see it being a boon for these types of regulations. I'll let somebody else if they'd like to comment on Gensler, but that's my view from the political side at large.
I'll go quickly. I think there's probably a tension between access and inclusion and financial crime considerations within the Democratic Party and just in general. The outgoing Department of Treasury was pretty negative on crypto and crypto wallets. We'll see what the new one is like, but I think every time we start talking about this topic, you get to the nature of crypto and the fact that people can have wallets without having an intermediary account, without KYC. And that is by definition inclusive and broadening of access to financial services and different kinds of assets. But it also introduces, some challenges on the law enforcement side. So I think that's a tension that probably almost certainly lives within the Democratic Party, and I'll be interested to see kind of where that settles. Steve?
Yeah, I guess the comment on Gary is I don't want to speculate on sort of how he'll approach this or rule, but I will say that he is well educated on the space, which is really encouraging. I've seen him at sort of small private conferences engaging with industry participants and other regulators. He's been on panels at some of the larger conferences. And so I think that part is refreshing. So again, time will tell sort of the position he takes on various things, but the fact that he is educated on the space, I think is great for crypto.
And we've only got 2 more minutes left here, but Steve, the people have waited long enough. Tell everyone about your first job experience. Everyone has hung around. Give the people what they want. What was the first job?
Sure. So this is a massive departure from crypto, but my first job was at an industrial laundromat in North Minneapolis, and I was on the maintenance crew. And among other tasks that I shared with the other panelists was that they would lower me down into these tanks to clean them, and it would be like 130 degrees in there in the middle of the summer, and it was a pretty rough job, but it toughened me up.
Oh, man. Everyone was sharing their first jobs before this, and Steve kind of swooped in with that story and took the cake. So I just wanted to share that with everyone. Guys, thank you so much. Unfortunately, that is all the time that we have for audience questions. I want to give a big shout out to John Nance and the folks at DealBox for making what was really just a fascinating conversation possible. So if you haven't had a chance, please go check them out. Their website is DLBX.io. Again, that's DLBX.io. Definitely go give them a shout. And if you guys enjoyed, for those in the audience, if you enjoyed this conversation, we're hosting another webinar on February 2nd. That's actually going to include Hester Pierce of the SEC, along with Caitlin Long, Perianne Boring, and Anthony Pompliano. And we're going to be talking about how some of the recent regulatory developments are already impacting the world of both financial services and kind of crypto. So guys, that is all the time that we have. Nick, Steve, John, thank you so much. It's been really fascinating, and hope to do it again soon.
Thanks a lot, Michael.
Thank you.